What if we told you there's a trading strategy that's delivered strong returns for decades by simply borrowing in one currency and investing in another? Sounds like free money, right? Well, not so fast. Today, we're diving into the Forex carry trade, how it works, why it sometimes fails spectacularly, and what smart investors do to manage the risk. Let's get into it. The idea of the Forex carry trade is simple. You borrow in a currency with low interest rates, like the Japanese yen, and invest in one with higher rates, like the Mexican peso. You pocket the difference, the carry. It's like earning 9% just for holding the right pair of currencies. Sounds easy enough, but reality is messier. According to economic theory, specifically something called uncovered interest rate parity, exchange rates should move in a way that cancels out these interest gains. So in theory, no free lunch. But in the real world, that theory often fails. Carry trades have delivered surprisingly strong and consistent returns, even beating well-known strategies like value and momentum, until they don't. The big problem? When things go wrong, they go wrong fast. Sudden policy changes, market panic, or global stress can trigger massive losses, wiping out months or even years of profits. This is known as the steamroller effect. Most people focus on volatility, how much prices bounce around. But in FX, what really matters is skewness. What happens during the worst-case scenarios? High-yield currencies like the Brazilian real or Mexican peso tend to make money most of the time, but can crash hard. They have skewness, like indicated on the screen. Low-yield, safe-haven currencies like the yen or Swiss franc lose slowly, until suddenly they surge during crises. Carry trade meltdowns follow a pattern. 1. Everyone piles into the same trade. 2. A shock hits, volatility spikes. 3. Investors rush to safety. 4. The trade unwinds fast. We saw it in 1998, 2008, and again during COVID in 2020. These trades can look like a goldmine until they explode. To manage risk better, Verdad research suggests using a two-factor model. Carry, the yield difference, dollar, the general trend of the US dollar versus other currencies. These two factors explain a lot of what's happening in FX returns and help you build more balanced exposure, according to Verdad research. But even that isn't enough. What if the high-yield currency is overvalued? That's where valuation comes in, specifically something called REER, or Real Effective Exchange Rate. REER adjusts for inflation and purchasing power, showing whether a currency is cheap or expensive. If you combine carry and valuation, you get a much better strategy. By going long on high-yield and undervalued currencies and short on low-yield and overvalued ones, you get stronger returns with fewer blowups. Verdad research used a set of 8 major currencies. To build the baseline carry portfolio, we ranked these currencies by their interest rate differentials versus the US dollar. Each month, Verdad research went 100% long, about 33% in each, on the 3 with the highest carry, and 100% short on the 3 with the lowest. This created a dollar-neutral portfolio with 200% gross exposure. When portfolios are rebalanced monthly, we get the equity curves shown on the screen. The adjusted carry trade strategy has worked well in the past, but is in a drawdown today. If you enjoyed this breakdown, hit the like button, subscribe, and let us know in the comments. Have you ever traded the carry trade?